Good evening, everybody. This is Jeff Scott. It is about 7:10 or so, 7:15 on February 28th, 2016, and this is my top-down review. For any contact, please use my email address at hgsidoc@gmail.com. I entitled today, Bull Trap ? As now we start to wonder, as we look at the three scenarios that I predicted last week. I predicted we'd run to between the 50 and the 200 as one of the scenarios, the most likely, and pull back. Well, we've broken above the 50. Will we pull back, or will we break above the 200-day moving average and head to new highs, which would be certainly will be warm music for the ears of the bulls. We'll take a look and see what we think. Or with the last 2 weeks just to sucker the bulls back in and the beginning of another leg down. Disclaimer, this is for education purposes only. Anything I recommend in the spirit of education should not be considered investment advice. I am a doctor, not a broker. I am not registered. I'm not affiliated with any software vendor or trading company. Everything I demonstrate I paid for. And as always, trading involves risks. And you alone are solely responsible for any decisions you might make. As I like to talk about, I've sort of tried to marry two styles of investing. Cancelim on the left is brought by William O'Neill, author as well as publisher and editor of Investors Business Daily. Made better in my mind by Morales and Kacher. And then made even better and made electronic by HGSI as influenced by Ian Woodward and Ron Brown. This is George Lea. He's my trading buddy. He lives in Canada, doesn't speaking with me at a lot of events. We'll be speaking together in Orange County this coming weekend, and there likely will not be a video next week unless I record something I'm doing live and post it. To the right is how I've taken Cancelim and I've made it work for me, and that's John Person. John shares a lot of the things and ideas that I do from a top-down perspective, but this is a guy that's been trading since I graduated med school. He's a publisher, a author, a trader, a teacher, and he's become a great friend of mine. And he's got some really great rules and great indicators, which frankly haven't changed in 20 years. And they've worked in bulls and bear markets, and they've really become a mainstay of my trading. And I will show you some of that tonight. And then Van Tharp, I think, is important for money management, position sizing, stops, etc. I have a lot of programs on my desktop. Almost purposefully, I make my desktop hidden so I don't have to get distracted. But I use Tradestation and Thinkorswim depending on what my goal is at the time. Frankly, like many of people I meet, I do a lot of my analytics in Tradestation or in Genesis and take the trades in Thinkorswim because I think their interface is easier. From an analytic perspective, I don't think anything beats HGSI from an after hours or even intra-market delayed perspective. HGSI plus Edge Rater is my way of doing things. I am a fan of seasonality. It's an interesting time in seasonal software because Best Choice is the old guy and they just got bought out, so we're looking for some refreshing. There certainly does appear to be a new interest level. Magenta Trader became my favorite, and then there was sort of a divorce of the Magenta family, and Seasonality Trader became the old Magenta Trader, and the Magenta Trader became an HTML5 based web program, which means it'll run on all your devices. I'm not going to tell you which is best, but I will tell you that competition's good because they all keep getting better. And then there's a number of websites I use as well. Now, every once in a while, I try and dedicate one of my recordings to just go over the things that I do and then apply them to the market. So I'm going to do that tonight. I called it the HGSI Doc Primer. And what I would like to show you is how I think, how I make decisions. And then as I go into my market review, hopefully for those that just sit there and just to hear what I'm buying and don't really follow along the different indicators, will have a clue. I think what I do, frankly, is very simple, but the vocabulary is painful. So let's see what I can teach you. Now, if you've heard this before, just fast forward until you get done with the PowerPoint and you'll get my complete top-down review that I normally do. I'm a top-down investor. What does that mean? It means that I recognize that the majority of the movement in tomorrow's stock is going to be what the market does. The futures, the cash price of the futures is positive. Fair market value, they're still a little bit negative right now. So not a big influence on anything that I'm talking about. If I think the market is going long, I'm going to try and find the best industry groups or sectors that are moving along with the market. And then I want to find the leading stocks in those sectors or industry groups that are moving lock and step with the marketplace. By buying top down, I've got the wind at my back. I'll show you some examples or some pictures of what happens when you buy when the market's going down. It's hard to make money going against the market, or it's hard to make money unless you really are a short-term in-the-moment trader. Most of my trades are swing trades in the direction of the market. I joke that the only time I day trade stocks is when I get stopped out the same day I put the order in. And I'll go long or short, and I do like to use options. For those that don't use options, despite all the hype and everything you hear, options can be great, but they're also can be powerfully bad. When you buy a stock, you need to know the direction, and you got as much time as you need. And when you buy an option, you need to know the direction. You have to have a target. You've got to pick a strike price, and you got to know how much time to give yourself. And you hear a lot of times that most options expire worthless. Well, that's probably not fair, because I think a lot of options are bought as protection strategies. But it does require a little bit more threading the needle than buying a stock. On the right-hand side are some of the indicators that might be confusing you if you've been watching me for a short period of time, have not been to one of my live meetings, or you just got here by mistake. So what I'm going to do is define every one of those about 8 to 10 indicators, and then I'll jump into my review. Now, HGSI, I still think is the best all-in-one analytic program. I think it beats all the other big names. It's much less expensive, it includes data. And the only downside of HGSI as of this moment is that it doesn't give me real-time updates. It does give me probably about a 10-minute delay, so I can get intraday updates. They're just a short delay. And I find that's wonderful because I can do entire analysis, say at 3:30, using 3:20 data, 3:15 data, so that at the end of day, if I think I need to change positions or add to them, I don't have to wait to after hours when it's a lot thinner. This is sort of the common cycle of fear and then greed and then fear. And the little boxes are the different indicators we're going to talk about. And these are some of the things that HGSI builds in that gives me a great and edge trader understanding of where the market might be. And for those who've been with me before, you know I'm all about the market before I am about the stocks. So Bongo, this is a timing indicator. This is something that I, along with several others, developed about, it could even be 6 years ago, 7 years ago. And it was trying to define a timing indicator for stocks and for the market. And frankly, if you are an ETF trader and you're an end-of-day trader or a stock trader, if you look at this, it gives some great signals for when to be in and out. Now, the weekly is slow. However, it is a very effective timing mechanism. And frankly, I don't like to go long in the setting of a red weekly bongo. I know I will go long, even though the bongo says short, but I know that that's a higher risk counter trend trial. The daily bongo is a lot faster, and you'll find during periods of uptrend when the weekly bongo is green and the daily bongo goes red that you'll have a pullback. So here are the criteria. Again, they're built into HGSI, and I also like to measure or look at how long since they fired. So bongo, purely this, timing mechanism, long or short, weekly or daily perspective, that I could get a sense of what the market is doing, and I could look for pullbacks in a long-term up up or green market with a short-term turning red, or vice versa. In a market that's in a downtrend, when I see the daily bongo go green, I'm retracing, and that might help me find a short. So I refer to the bongo a lot, and this is the definition. And those are Wilder RSIs of different lengths, and the key is the order that we find them. I'll occasionally talk about the bingo. And the bingo is sort of how do you measure capitulation? And when I think about the term capitulation, I think of the baby out with the bathwater. It's when the market is going through a major correction, and perhaps before you get near the end, even good stocks start selling off as perhaps funds liquidate. This is a mathematical calculation that will fire on a stock or a market and give me a sense that we may be getting close to capitulation. Now, I've seen markets like 2008 where you get a little pause in a fall and not capitulation for a bingo. So all it should do is make you see if you have capitulation, but it itself is not an answer for capitulation. And then if you are followers of Investors Business Daily and William O'Neill, you know that they have something called a follow-through day, which occurs within so many days after a market reverses. It requires a percent move of the stock price, as well as more volume than the prior day. And these are a follow-through day. And we find that follow-through days might be a good signal of the market turning around. A eureka is a follow-through day equivalent that we've programmed into HGSI. And you could see the criteria here, while the Phoenix is a follow-through day to the downside. Let me tell you something about a follow-through day. If I've had a market that's had a very long run up and it shows me a eureka, when I see after a long run exuberance coming into the market, that may be a warning that this market is done. When I see a market that's been selling off hard for a prolonged period of time, when I see a Phoenix at the bottom, it tells me that perhaps we're getting near the end of that move. So again, at the beginning of a move up, after you've had perhaps a reversal day, a few days later, if you see a eureka, that is your HGSI signal of a follow-through day. If, on the other hand, the market's been going up for a long time and you see a Phoenix, then that's a potential market's going to turn down signal. So here is the market in 2000, 2007, 8, and 9. And just to give you a clue of what the things I'm looking at here, and this may or may not be project okay in the video. On the top, I have the weekly bongo. You'll notice from mid-2008, when the market was sitting in the neighborhood of, among friends, 9,200, until the end of 2008, when the market was now sitting closer to 5,360, my weekly bongo went red. The only time on this chart my weekly bongo was green was during a retracement or a move up to the highs in 07, a retracement off the bottom in 08, and then at the end of the swoon as we went into the end of 08 prior to the often referred to March 9th bottom. You will notice that these gray bars are bingos, and I think the important thing to notice here is that although often you'll see a bingo and then the market will rally, in a horrible bear market, you may get bingo after bingo so much that it looks like you're painting a stroke. Now, the other thing that's I want to look at here is ignore the bottom. We haven't taught you kahunas yet. This is the Eureka and the Phoenix row. Now, Eurekas and Phoenixes only occur in the setting of the NYSE or the NASDAQ. So when I look at any other chart, if I'm looking at a Phoenix or Eureka, then it's telling me that this is what occurred on the NYSE or the NASDAQ, depending on my settings. So it gives me a great view of the market. So what really got me excited would be when you start to see a series of bingos, a series of green phoenixes, like occurring down here, 1, 2, 3, 4 in a row in November and December of 2008. And frankly, that probably is where the market stopped falling. But, you know, I didn't get my big buy signals until March. So we have bingos here. We have phoenixes in red, eurekas in green. I showed you the bond goes up here. The next thing down here is accumulation distribution, A, B, C, D, E, just like you would on any other program or an IBD. And we'll talk about the force index later. We're going to skip this one here in the bandwidth. That was an old slide. And then the other thing I wanted to point out is something called the Hindenburg. And the Hindenburg omen is something I look for every night when I run my numbers. Now, I don't really look for it now because the market's not near a high. And I didn't look for it from 2009 to 2011 because we were still catching up to where we were. But when we get out to new high territory, I look for these red lines. And the Hindenburg, there's a calculation. It's one, HGSI is probably the only program I've ever seen that actually has it built in. But the Hindenburg is a sign of the big money getting out and the small money like us buying their shares. And it's often a sign of a market top. Now, if I showed you early 2007, you'd see there was a top over here with a number of Hindenburgs fell or fired. The market had a drop. Market came back up to a double top. And I'm not looking for a single or even two Hindenburgs, but I'm looking for this picture here. And frankly, had you seen that and got out of the market, you would have got out of the market at about 9,400 or higher. So the Hindenburgs are important to me as well. I mentioned force. This is from Alexander Elder. And force is defined as volume today times close today minus close yesterday. So the two things that can make the force go up would be a positive price change and volume. The bigger the change, the bigger the volume, the more the force is going to be. A bank that has 25 million shares a day, it's always going to be near the top of the force if it's positive, and it's going to be near the top of the bottom of the weak ones if it's negative because of that volume. Now, I don't go into this today, but this is some work done by John Alexander Sarkit, who uses the force to determine specific buy and sell rules. Now, I use the force similar to the bongo, that if the 2-day EMA of the force, the short-term force, turns negative, while the 13-day EMA is positive, that's another sign of a pullback in an uptrend or vice versa. The force is available in almost every program. And the other thing that I use force for, which is totally unusual, that we learned from Ian and Ron, is I use force as a momentum tool to look at what groups are moving, which I'll show you in a while. I mentioned in the intro that I like Morales and Kacher, and that they have, I think, added much to the world of canceling, and pocket pivots, Bible gap ups, great philosophy about shorting. These are their three books, more recent books that they wrote together. And you can pause this to read about it, but pocket pivots are something they came up with as an early indicator of a stock moving, and that they want to get in before the folks that follow canceling and their cup and handle breakouts. There also can be great opportunities for follow-on buys. They're programmed, hard-coded into HGSI, and can be coded for and observed real-time in multiple platforms. There's a lot of folks that are out there talking about gaps. Their Bible gap up to me, not only do they work, and is it an effective way of figuring out whether to join a gap move or not. I've been very pleased with the Bible gap up that I find from M&K, and they have to have 0.75 times the 40-day ATR and 150% of the 50-day moving average. And these identify gaps that often are very buyable. Now, you need to read the books. and understand how to use them. But these gaps have trading rules around them, stop rules, etc. A few other folks that I add to my armamentum. David Elliott, another great trader, recently, well, not so recent anymore, probably 3 years ago, passed away. Has a number of things on the internet. I'm not sure his wife has continued to market his goods since his untimely passing. But if you can get a hold of any of his videos or his recordings, it's worth taking a look at. And he introduced us to a number of things. Now, if you have Thinkorswim, you have much of his stuff in there. You have his MOBO breakouts and his soaps and other things. And in fact, I use Squeeze, which he also talked a lot about, which you can find under John Carter's. And I'm just not going to spend much time here except to say it's built into HGSI. And MOBO breakout and MOBO breakdown are buy and sell signals that occur. They are not Bollinger Bands. They're a derivation of Bollinger Bands. And for me, they're another type of momentum indicator. And then lastly, I've talked about him often, good friend of mine, John Person. These are two of his more recent books. He does live education. He does mentoring. He has a chat room. He's a top-down trader. He'll trade futures. He'll trade stocks. He'll trade options. And he uses the same technique regardless of what time frame and what he's trading. And frankly, whatever decade we're in. And when I find somebody that's successful and has created a system that seems to work in almost any market and has worked over 20 years plus, I pay attention. He has a PPS buy signal. It's for free on Thinkorswim. You can scan for it as well as plot it. And then there are packages for Tradestation and Genesis. There is 10% of what he does is free in Thinkorswim. In Tradestation or Genesis, which are not free, are packages that can be done monthly or lifetime. I'm a lifetime guy. I hate paying by the month. That offer his whole suite of tools, including his HCDs and LCDs, and his interpretation of OBV and his pivots. Time-tested signals, I use them in multiple time frames. What I really like is I like to scan. And this was a scan, I better put my glasses on because it's even small for me to see here, that I ran this weekend. And this is on Weyerhaeuser. I guess it's a paper company or lumber company turned REIT. And what I scanned for here are weekly high-close dojis, and they plot in orange. And this happens to be, I think, his best buy signal and best reversal signal. So there were a bunch of them this week, and I looked at each of them as I tried to find my stocks to buy for this weekend. And he has a number of high probability setups. As I said, he has a unique way of using on-balance volume. These are some of his moving average, pivot moving averages, his buy and sell signals. And I combine many of these things when I look at my chart of the week and talk about why I'm taking a trade. I've learned so much from John and so much appreciate it. I appreciate it so much that I started a user group called the Pug User Group, which I'll allude to at the end of our presentation, where I bring together the best of HGSI and John's indicators. You buy his indicators, hopefully you buy HGSI, and the rest come free, training, chat rooms from time to time, and a number of videos that John prepares to help us use his indicators. There's nothing worse, and I'm a victim of this too, of buying somebody's product and never knowing how to use it. My trading plan. I have a number of favorite setups. I just went through a number of them. Frankly, I like to find something at support that moves up or down on momentum, looking at my Kahunas, which I forgot to put in the chart, so I'll go talk about those real quickly. The Kahuna, let me just tell you what it is right now. The Kahuna is a measurement of movement within the Bollinger Bands. That if you imagine the lower Bollinger Band is 0, and the upper Bollinger Band is 100, if someone told me the stock went from a percent B of 0.5 to 0.6, then I knew it moved 10% within the Bollinger Bands. Turns out that when you have a big move, 24% is a medium move and 40% is a very big move, that those often signify a change and some momentum coming into your instrument. So Kahunas, mobile breakouts, pocket pivots, viable gap ups, HCDs, PPS buys are all some of my favorite momentum indicators. And I look for them in the direction of the market and coming at support and resistance. I had a question about my one-to-one that I talk about in the charts of the week, risk reward. So I set my initial stop based upon the chart. The looser the stop, the more risk and the fewer shares. By buying at support, I can have a tight stop. I set a 1-to-1 or 2-to-1 minimum for reward to risk, or opposite way if you want to call it risk reward. What that means is if I'm risking $1, I want to make at least $1. If I'm in times of a more bullish market, I might look at a 2-to-1 or even a 3-to-1 where I'm hoping to get a 2 to 3 return for my dollar. Now, I'm currently only looking to get 1-to-1 returns. Why? Well, if you've been watching me for any time, I put these charts the weekend on Sunday, I buy them on Monday, and on Wednesday they hit my target, and by Friday they were losers. So I've learned to, in this market, set my reward at 1 times the risk I'm taking. When I hit my first target at 1 times the risk, I take half off. I move my stop to break even, and then I let it run. And I use some various stops, including chandeliers and other trailing stops at this point. And I've really learned over the past year to take profits, and the key is no one ever blew up an account taking profits. And everybody that I know at some point in their career have blown up an account, and that includes me as well. Now, these are old slides of an uptrend, a downtrend, and a Darvas box. What I'm looking for is where these circles are to find momentum in the direction of the overall trend. So I want to buy a pullback to support here, and then I want to see momentum coming in. So again, a mobile breakout, a pocket pivot, a viable gap up that hasn't run too far, a Kahuna. In a downtrending market, I look to short retracements. You notice there's no red arrow on an uptrend, there's no green arrow on a downtrend. I'm not that good. If I was shorting an uptrend, I have a very short period of time that I could short it at its peaks when it hit resistance and cover it at support. Those are tough. And I guess if you're in the market all day long or you're a computer whiz and you can do an amazing job at programming your stops, maybe that's for you. I'd rather go long in uptrends and short in downtrends. Same way here, if I went long, it would have to be at each of these 3 arrow points. That's a very short trade, and it's not going to give me much risk to reward, so I'm not going to take that trade. A little bit more confusing, perhaps, on the sideways market, which is what markets are supposed to be in most of the time. I think somebody's told the market or forgot to tell that to the market over the last several weeks. But in a sideways market, I like to buy off of support, the green arrows, show me momentum at support, and I like to sell off of resistance. Now, I will buy breakouts above resistance and sell breakdowns below support, especially if the overall market is in that direction. So that summarizes very quickly, maybe not quick enough for you oldies, of the various indicators that I spend a lot of time with. And so I urge you to go spend some time learning about what John Person does, what Morales and Kacher does, and to test out HGSI or some of the other things that I do to help you be successful in the market. So let's take a look at the market. This is what I call my sector review, or should I say what John calls his sector review, which he gives to people that own his package. And what I have here is some of the major sectors, the stocks, and I'm looking for clues to what's working and what's not working. Materials have been strong. Materials were strong on Friday. Interestingly, banks, despite the interest rates being so low, perhaps they got a boost because the GDP came in higher, a less bad number than what was anticipated. Now, those were strong. Notice how utilities, and this is something I learned from John Person, almost all these are selling off 2 or 3%. Somebody must think that the market's moving up higher, and perhaps they're getting some risk off and moving some risk on, and they're unloading utilities, but almost every utility was down on the day. You could look through, you could see that energy, services, and production were great. Some of the big multinationals and larger energy companies a little bit more mixed. Some of the other things, such as solar, were down, probably because of First Solar. So this just gives me a sense of where money is moving. Then, let me just make this easier. Let me look at it live. Make sure the recording's working. Nothing worse than getting through an hour-and-a-half program and realizing you forgot to start the recording. So I think this one's the daily. This is my view in Thinkorswim. I'm looking at the E-minis, the NQs, the YMs, the TFs, the VX, and the DX. So the first four are the major markets. Then the VIX might be contra to that, and then the dollar. I have a lot of crap on my slides. I know that, or on my charts. But it's all the same things we've been talking about. Notice that the E-minis are now up 2.75. Fair value is about 2.6, so they're still flat. The NQs are up 4.75. Fair value is 3, so they're up about 1 above fair value. YMs are up 18. Fair market value is 15. And the TFs are up $1, and fair market value is 50 cents, 43 cents. So they're all pretty flat, but trading to the upside. The VIX is down less than 0.5%, and the dollar is up a few pennies. Probably the main one that people want to look at today, based upon the market, and this is for a much bigger screen, so ignore the things to the left, but we can see that oil's up a nickel very early, and gold's up $1.90. So if I go back to my daily charts, what do I see here? The red's the 200, the yellow's the 50, the green is the 17. Last week, 1, 2, 3, 4, we were sitting below the 50, and I said that I had 3 scenarios. The first scenario was we'd fail at the 50, not get above it, and set a new low. Well, we pretty much broke out of that one. The second was we get up to the 200 and roll over, and we still have a lot to prove before we get to the 200. The third scenario was we break above the 200 and move to new highs. I still think that one's not likely, although anything is possible. No one would be happier than me because I'm still net long in the market. But I've got to be prepared, and I am, that we stall out somewhere in here and come back down. That's what I'm looking for. Right now I'm trading what I got, which is a market that's moved up steadily since this 1802 low up to 2019, and that was from 211. So in 2 weeks, the market has moved up to 1945, so that's 135 points. Market's had a big move, no question about it. So I see the S&P broke above the 50, retested it on Thursday, was up a little bit on Friday, broke above it on Thursday, retested on Friday and held, and looks like it's up a little bit today. The NASDAQ still has not gotten above its 50. It failed at the 50. I'm looking for the NASDAQ 100 to get back above that 50 quickly, or I'll have to start thinking about playing more defensive. The YMs broke above the 50 on Thursday, held on Friday, and are trading up a few pennies today. The Russell futures are stalling out right at the 50. So if I'm bullish, I'm going to look at that E-mini and that YM and say they broke right through that 50. They held the next day. Let's see where we go. If I'm a little bit more cautious, I'm going to look at the NASDAQ and the YM and the Russell, which right now are stalled out at that descending 50-day moving average. I have a short list that I'm going to build after this call because if this market turns, these might be a great opportunity for shorting. But that's why I call this a bull trap question mark. If we can break above the 50 on the NASDAQ, on the Russell, I'll feel a lot better. The VIX is trading down, not as low as it's been, but it's come off of its highs, and the dollar is sort of going sideways, but it did have a run-up last week at the end, especially with the better-than-expected GDP. If I look at the weekly charts real quickly, you could see, first of all, these blue are the John Persons PPS buy signals, which popped up pretty much throughout the market over the last week or two. And you could see we pulled down close to the 200 weekly on the ES and bounced. We still got to get above the 50 weekly on each of these. And on the Russells below the 200 weekly. Now you got to believe with this 200 weekly and 17 weekly that there could be some resistance that is right above where some of these major markets are. So enough, I think, to not just go and put every penny you got into the market and to still play a little bit defensive, but I am net to the long side. I'm certainly not all in. This is my Genesis screen, and I just copy this. We'll look at the bottom two rows. You have the E-minis, then you have the NASDAQs, the Russell, NYSE, and the YM. And the only point I wanted to bring up is we're in a buy signal weekly on the bottom and daily in the middle on each of these indexes. Typically, that's a great signal, but again, you could have concern that we've run too far too fast. Now, in white, you have the 10-year Treasury yield. On the next group of slides, they're all the same basic setup. What I'm looking at will be in white. The S&P or the spiders are in yellow, so I can see the relationship between what I'm looking at and the market. And then in blue, I've got a 50-day moving average, and in red, a 200-day moving average. Here I'm looking at 10-year Fed rates. And we moved up a little bit being the key word this week. But if Janet and the Fed are going to tighten 4 times this year, why are interest rates trading at 1.76? I don't get it. Low rates are good for REITs. Saw that today. MLP, saw that today. Utilities, not as many showed up today. Dividend payers look good. And although I didn't have any frank buy signals in the home builders, there are a couple that were close. And so many that it makes me think that home builders might be interesting. Banks typically do not perform as well in low interest rate environment, especially regionals and insurers. And perhaps Friday have made people reevaluate interest rates. Maybe that's why utilities are down, because they did look to be stirring, especially in the regional banks. I think the regional banks are going to be the haves and the have-nots, where some of them are going to be banks that have a exposure to the oil, and they're going to be the have-nots. And then you're going to have those banks that do not have oil exposure. They are the haves, and if interest rates start to go up, I look for those to outperform. AD lines, white is the Russell 2000 on the left, the 1,000 on the right. So the first thing is that it's clear that the 2,000 rolled over much more than the 1,000. So small stocks were worse than big stocks, but they both turned up this week. That's nice. How about participation? These are percentage of stocks above the 200-day moving average. We still have 76% of stocks are below their 200-day moving average. This is usually where market rebounds from. I correlate that with over 60% of stocks are above their 40-day SMA. And if I look at a 4-week new highs and new lows, we've rocketed up. And frankly, we're at that point where the market typically reverses. I believe that the chart on the right showing a high number of stocks above the 40-day SMA, as well as a lot of a high number of 4-week new highs versus new lows, could be evidence that we need to take a pause here. Don't have to pull back hard, and maybe we'll have another run up. But at worst case, a pause might be in our future. The McClellan also approaching overbought. It's at positive 168. And you could see the market typically gets to 240, 260 before it reverses, but the McClellan's had a big move up. And the summation index, though, is still negative, arguing against the need to reverse. Some of the other things I like to look at, these are my buckets. Learned this from Ian, made automated by EdgeRater. Take the S&P 1500. The reason why it says 3/2016 is I revised the list. So this is a new list, and this is the last list, so there might be some small changes. To the right is last week, to the left is this week. And what it shows you is on the right in the pie chart, what percentage of stocks in the S&P 1500 are above their midline versus how many are below. When you get above 80%, that's very bullish. So we've moved bullish there. And then on the left, we take the 10 slices between 0 and 100, 10 percentiles, add one for below and one for above, and we see where the stocks are falling. And we've only got about 7% of the stocks above the upper band. That's not a very big number. So this is a very bullish sign and doesn't signal any extreme overbought. This is a very helpful tool at times of market extremes. I mentioned the Hindi. There's an automated scan here in EdgeRater, as you could see, and just looking down here, there's no red yes, so we have no evidence of a Hindenburg. Last week I mentioned that there was a Kahuna, and after that Kahuna, I thought maybe maybe 2 weeks ago, we might flip to green, which we did on the second set of Kahunas here. These are Kahunas on the major indexes. This is percent B. This third set of columns is the Woody indicator, percent B times percent B change, or percent B times bandwidth rather. And we are in a clear buy signal on the Woody indicator. This yellow tells me that's still very volatile. Nice to see white when I get the green because that tells me less volatility. I have a number of stocks that we call the canaries that I look at on a nightly basis, an index made up of them. They're the FANG stocks, adding Tesla and Priceline, and it gives me a good clue, and a few others, you can see them listed here, of what the NASDAQ 100 is doing and could be a proxy for the overall market. What we see here is that last week, 1, 2, 3, 4, 5, so I think there's only 5. We've moved above the 17-day, went sideways, and now we have hopefully not a spinning top, just an indecision day. So we've moved off the 17-day. We're above the 8-day. I'd be a lot happier when I saw the canaries bust out above their 50-day moving average. Here's some of the FANG stocks. Here's Google, sideways down, right below the PSAR dot. Could be a good spot to break up. Be nice to see it above its 50-day moving average. Here is Amazon. Amazon has moved up nicely, about 70 points, 80 points from its lows, but it's in no man's land between the 50 and 200, certainly short-term moving up. And this was a bingo. This was a phoenix on the market and a number of pocket pivots. Amazon of late has really started behaving better, although it's not moving much. Up here is Facebook. This is the only FANG stock that's holding above all its moving averages. Looks like it had a PSAR reversal on Friday. It also had a red candle high. This is, I won't say it's extended by any means, but of the 4 FANG stocks, it's the best looking one, and it too doesn't look so great right now. And then lastly, we have Netflix, which fell hard at the beginning of the month and has moved back up above 92, kind of a shooting star like on Friday, so we'll see what it does tomorrow. Lowry is a research firm I subscribe to. It's a lot easier to be bullish when the buying power is above the selling power. And you could see, although they're starting to close the gap a little bit, selling power is much higher than buying power. So what are my thoughts? My thoughts are we had a stealthy 2-week rally back into an area of predicted resistance. Shorter term, some of my indicators are becoming more overbought. Many of leading stocks have moved to short-term areas of resistance at downtrending major moving averages. This might be a fresh shorting opportunity, but don't short just because I say so. Wait for signals. Last week we predicted 3 signals. I thought we'd end up somewhere between the first 2. I'm not changing my mind. And this is still a bear market rally, and this could turn into a bull trap. Remember, patterns are cyclical. You want to be greedy when you begin a new move up, and you want to be fearful on a new move down. During a sideways market, there's uncertainty. You got to play the market based upon where you are. And I still think we're somewhere on stage 4. We might be nearing the end. And I take a defensive position. If I think we're here, then I start to nibble on stocks, buy calls, etc. Whatever I'm doing, and I'm probably starting to do some of this box on the left short term, longer term, I'm still concerned. And that means small position sizes, protection stops, even some collars. Know your earnings and news dates. Levitt Brothers is a service. They sell things. They also have a free page on their website where I download this from. So you can see we got some PMI, some auto sales, mortgage index, employment changes, energy, trade balance. So a fair amount of information this week. Earnings are starting to slow down, but there's still some that you probably care about. And as I say here, it's a judgment call to hold the stock over earnings. It's bad judgment to not know when your stock's earnings date is scheduled. We've gone through the introductory comments. Now we're going to jump into my current market review, a short top-down analysis, a little bit of my bottoms-up work, and say goodnight and go through the chart of the week. So this is last week's chart. I'll make it simple. I wanted to protect myself with a bearish call. I chose GMT, Gaddix Corp. I selected had to trade below the close of last week before I take the trade. Why did I like this? There was a low close doji on the daily, PPS sell on the daily, OBV heading down on daily and weekly. There was a Kahuna Forest Mobile breakdown to the downside. So I said if the market was stable, short it at the white line. My stop was the red line, and my target would be the green line. So I didn't get filled on, here it is over here, on Monday. And 2, 3, 4. I didn't get filled the first trading day of the week, and the market seemed to have strength, so I took my trade off. Frankly, it's still sitting right underneath the 50-day moving average and is probably still very shortable if this market rolls over. But right now I took the short off and never filled it. So close your eyes so you don't see next week's pick, and let's play a little bit. All right. All right. Let's quickly look at the state of the markets in Tradestation. What I like to do here is just get an idea in Tradestation of what the markets are doing from a daily, weekly, and monthly perspective. I look at person's buy signal, which is the arrows. I look at a MACD divergence scanner, which are the dots attached to price. And I look at the color of the price bar, which is the elder indicator, where green means it's okay to buy or hold, red means it's okay to short or hold, and blue I can do whatever I want. I don't buy when it's green, it's red, and I don't sell when it's green. So let's look at the cash markets. Let's look at the NASDAQ. And the NASDAQ is now in a buy in the weekly and in the daily signals. It's green, has had a nice move up. It's not up near the upper envelope. I'd say that looks very bullish. The Dow, green and green, so daily, weekly, and monthly have turned green. The monthly is red here, which is, means you're going against a longer-term downtrend. Still has room to go to the top of its, these are elder envelopes. I consider that to be bullish. I look at the S&P 500. I think there's green in there. There's a green line there. I just figure out how do I find it. Hold on a second. Well, you're going to have to trust me that there's a arrow in there. let's see what I can make smaller. Let me see if I can find it. If not, I'm not going to worry about it. I know it's there because it's in my other computer. No, I'm not going to see it. You're in a buy signal on the S&P, on the daily, and on the weekly. You can see it here. Still in a sell signal on the monthly. And if I look at the Russell, buy, buy. So we see more strength across the major markets than we've seen for quite some time. If I look at the sectors real quickly, materials, buy, monthly sell, very strong. Materials have been leaders. Energy in a daily sell, weekly buy. So is it starting to be in a longer term uptrend, and that was a retracement? Possible. Financials, a new buy on Friday. Again, perhaps this was related to the strength in the GDP, but we saw that in stocks, and we see it with a new buy here and a new buy on the weekly. Industrials, longer term have been in a buy, both daily, weekly. Technology, in a buy, daily and weekly. Staples. Staples are a little bit bothersome. You notice these red dots at the top. Those mean some potential MACD bearish divergence. From here to here, I've got a higher high. I don't have a higher on the MACD histogram. That would suggest that the uptrend is losing some steam. I've got it on the weekly, so Staples might be ready to pull back. Utilities, we had a sell signal. We knew they were weaker from some of the earlier views that we looked at. Still, on a longer-term basis, they're okay. Healthcare has been weak, but it too has in a buy signal on the daily and the weekly. And the last thing is discretionary, which still is okay. So the weak things is probably just the staples are the one that comes out and hits me. Let's go into HGSI, and let's start by going into major market, Woodward Brown user groups, major markets plus, and let's put in the T1 view, which is all price and volume. Looks at 1 day more than 5 days more than 3 weeks, and see strength was in the market in the small and mid caps. You know that's great if you're a growth stock investor. And we look down here, weakness in silver, gold, and volatility. I like to look at some of my favorites. We know there were no Kahunas on Thursday or Friday, so I'm going to get out of this chart view and go into the cleanest view I have, which is, I guess this time we put the bongos on last week, so I'm going to leave them here. We have no Hindenburg, no surprise, and we got weekly bongo is green, daily bongo is red. All right, let's get into the S&P 500. And I'll show you how I use those. So here was last week. Scenario number 1 was in red, that we would fail kind of where we were last week, which I think was this bar. Either we'd run up to the 50 and fail there, or we'd fail right away. That was scenario number 1. Scenario number 2 was we'd break out, get above the 50, and make it somewhere close to that 200 and reverse. And this is what I anticipated, and frankly, I still hope we do this and we come back and then test and hold the 50, and then we move on to new highs. And scenario 3 was we break out to new highs as it is. So there are some things to report to you that have changed here. So the first thing is we did break above and retest on Friday the 50-day moving average. That's outstanding. I mean, we've sort of got a W here, and are we breaking out of that W? We're kind of getting at an interesting place here. If we use the height of the middle, then we've broken out of the W. So that might be a bullish signal. If I just measure from where we've come, at the close, we moved up 8% in 10 days. That's a pretty dynamic move. I also could point out that if I hold my shift key down and I draw a line here, we're at a double bottom there. And we made it through that bottom as well. So we've had a nice move. All I could say is we're retesting the 50. Anything can happen here. I'm not expecting us to run right through that 200. And if we don't hold at the 50, it might be time to call it a trap and start shorting. That's the S&P 500. The Dow, similar pattern. Notice the bongo weekly turned here as well as it did on the S&P. That's a nice signal. It's a positive longer-term buy signal that happening. That makes me kind of excited. And look at how much grief you would have missed. You would have gone short over here or out of the market, and you would have covered it over here. Late out, late in, but you still missed most of the carnage. The NASDAQ composite, stalling at the 50. Still like to see it move up from there. And then the Russell 2000, I think it's right below the 50. So those last two have a little work to do, but short term, everything is in uptrends. And even though the Russell's the weakest, it's up 10% in 10 trading days. So a pretty powerful move, hence the concern that maybe we're going to get oversold here, at least on the short term. The dollar moved up nicely on Friday with the GDP revision higher, but it's sort of in a sideways move that's been in for some time, using UPP, or UUP rather, as the ticker. And then the VIX, not as low as it can get, but it's come down to the 200 where it held on Friday. It's higher than where it's been when it's rested before, so it'll be interesting to see if it moves down further or if it bounces from here, which would be bad for the market. Firming up dollar means gold and silver were probably under pressure, and gold holding above the 8-day moving average. The bongos are positive. You know, gold will go up if there's concern about the world or the dollar falls. Right now the dollar's down and gold is up. I'd be careful if I'm long. If I was playing Nugget or JNUG, 3 times ETF on gold, I'd probably be careful here. Silver broke down. And this is kind of what I was concerned about, where it's failed to stay above its 200 now each time that's broken above. So you can get some great moves. I mean, huge moves. Here was a 16% move, but every time gold and silver pop back up like a whack-a-mole, somebody's there to pound them back down. Next, I like to figure out what industry groups are working. Well, it's been a strong market for some time, so one would expect to see lots of industry groups that have momentum to the upside. You could see we have 172 securities that we are industry groups. If I look at 2-day force up, here's I'm using force momentum to show it's working in the short term. I can do a right click and start to go down the list. So junk off the bottom, this is Newfield Energy, had a 6% move on Friday. Massive volume. Notice, again, my little bongo friend would have gotten me out of the market up here at 38 and saved me most of the pullback. We're still in a weekly bongo red. Don't know if that's a one-day wonder. Earnings suck. Eventually, oil's going to firm, and these stocks are going to go up. Continental Resources, I'm dying to nibble on this one because this has been a great performer over time. I wish I had Lou Powers on this call. Here's your up and your down. Is this ending the bear phase and going back into our bull phase? I don't know. But here's that pattern that you'll see over and over again, even in smaller time frames. I do notice that unlike the last one, change this back to daily. Notice we got a weekly bongo turn green. Continental Resources is on my buy list, high risk buy, probably high reward. Marathon, similar pattern, cheap stock, still in a weekly bongo down. Devon, I mean, most of these charts look awful. Here's another one, Hess, that broke above the 50, and its weekly bongo went green. Earnings are horrible. I think there's a lot of expectation that Perhaps OPEC's going to do something to stabilize the price of of oil, rather. I don't know what I was thinking. And then hopefully that will lead to these moving up quickly. Services, some of the smaller guys here. Let's go back into my full chart that has all the things I mentioned. So here's Rowan Companies. Weekly bond goes red, daily bond goes green, dark green on accumulation. Both forces are positive. This is the high jump bar. As long as it's not at the top, I'll ignore it. This is my Bible gap up window. There's nothing there. It's in a squeeze, has a mobile breakout, had a pocket pivot on Friday and a big kahuna. So a lot to like on Rowan Corporation. It makes money, trades at a minuscule PE, and pays a nice dividend. As long as they don't go bankrupt. So if they pay 3% on $13, they pay 40 cents. Looks like they have plenty of earnings to pay its dividend. Transocean Rig. And a lot of these, even though it says here they have a dividend, you want to check because many of these, I believe, have canceled their dividends this year. Hard to get excited about some of these stocks. These have been killed, and they've been in profound downtrends. Has this found a base? Is done going down? This is Weatherford? Maybe. ESV. Hard for me to get excited by this group. Back, and we are sorted by raw combo. Department stores. Who would have thought JCPenney was leading the way up? Bible gap up on JCPenney, closing near the high. Look, they had great numbers. It used to be a much more expensive stock. It's been in the penalty box for a long time. It's been losing money for a long time. Hard to get excited. However, the weekly bongo just turned green. Pays a 3%, excuse me, does not pay a dividend, my bad. It's a Bible gap up. I might buy it here, put my stop probably, the rule is down here at the bottom. That's the problem. Your stop would be about 12% away. JCPenney, I won't shop there. Maybe I'll shop for it and buy some. Dillard's moving up off the bottom nicely, has to get above that 200. Everything is green. And Kohl's Corp talking about going private. This is what I do. I go through my top 10 groups, infrastructure, software, and I look to see if there's anything I want to buy. This one's a great one to talk about. Let's look at a weekly chart. Here's a company that you can see I've used this as a model before, so let's clear those and let's start all over. So this stock had run up 400% between June and July. Those are those are weekly. So between 13 and 15 in 2 years, it went up 400%. Let's switch this to a daily. So it had a huge run up and has been struggling ever since July of 2015. Let's go back to the daily. Here we are in July of 2015. It bounced around its 200. It broke here, and it had a further correction. It had great earnings on Friday, surprised the street, and as you can see, it moved up to the 50-day moving average. It has had a number of kahunas in the last couple of days, 3 out of 4, still in a downtrend on the bongo weekly. How do I play Palo Alto? It might be a great buy here. To me, it's run too much. I'm more interested on the short side. If this market rolls over and I get a sell signal somewhere between where we're at here and that 200-day moving average, it may have just lined up in a great place to short. So some of these stocks, here it is, a big up move, downtrending major moving average, and this goes on to a list that could be a potential short list. Now, I don't just short because of what I see. I've got to see the move to the downside, and I don't expect it, but I'm going to have a few of these that I'm going to be watching just in case. Because if this market rolls over, Palo Alto's rolling over with it. Same thing with Splunk. You notice how it closed way off where it opened and its high of the day? Palo sort of closed in the middle. Again, running up to its downtrending trend line or moving average. Rackspace, I like this one a little bit more. It had a Kahuna, traded up to its 50-day moving average. Everything turned green, and Rackspace is one that I put on my buy list. Notice we've been in a tough market. These leading groups are all downtrends. Here's a couple of regional banks. You can see they've sold off hard ever since the beginning of this year, trying to find a bottom. Had a pocket pivot on Friday and a mobile breakout, still in a weekly bongo red. This is Citizens. I think I'll pass. BB&T had a Kahuna. It's got a lot of resistance ahead. Huntington Bank shares could move up $1.60 Kahuna. Mobile breakout from a squeeze. So these look very similar. These are stocks that have been in a pretty sharp short-term downtrend that are bouncing around the bottom. Sometimes I don't even want to fight and I'll go look at the regional bank ETF, KRE. And again, it looks just like the stocks. A mobile breakout on good volume. It's got the 50 right here. If it can get through that or right up to the 200 is not out of the question. I also would like to see the bongo weekly go green. So if you're thinking to yourself, I'm not finding a lot to buy, you're right. Bank of America is probably the best of the bunch, but another not best of the bunch bank, but pattern still in a bongo weekly downtrend. Big pullback here, moved up the last couple of days, could run up a couple bucks, which is about 20% before it gets up to its descending trend line, still in a downtrend and still one to be careful of. Citi, JP Morgan, Wells Fargo all look about the same with less move to run before they get to their resistance. This is what I do every night. I mentioned MLPs do well in a falling interest rate environment because they pay a big dividend and they also have infrastructure needs. Here's Target Resources, pay a 14% dividend. The problem with this and a lot of them is you see how hard they've fallen, 132 down to 22, which is why they have these big yields, is how are they going to pay this? And again, just because it says so in a program doesn't mean they're going to pay it. They can cancel their dividend any time, or they may have canceled it and it won't show up until there's missed dividends. So be careful. We did get a bongo weekly green, which is kind of interesting. There's no earnings these 2 quarters. 14% of $28 is about $3 a share that they're going to have to pay in dividends. If they don't have it here, I don't know where it's going to come from. I don't know what to do with these. Cheniere Energy, Enbridge, One OK Partners, these all pay substantial dividends. They've all been in big downtrends. If they found the bottom and they actually pay their dividends, you can make a nice return on your investment. If they drop 10% and they pay a 4% dividend, it'll take you 2.5 years to get your money back. Semiconductor devices. Wish I could tell you these are all great charts. They're not. SanDisk, everything is green, did break above the 50. I don't like its earnings per share, lack of growth, but sideways move. Not that exciting, but at least it's got a weekly bongo that just changed. Intel Corporation, NXP, Avago, probably the one I like the most, I guess, and I don't like it that much. It's above its 50. It's still in a downtrend by weekly bongo. Nah, I don't like this one either. I just have a hard time buying downtrending stocks when they've come off of support. It's a little bit late. Here's Microchip. If this market rolls over, negative earnings per share growth, what a great shorting position as it runs into the 200-day moving average. Now, I don't know if it will, but I'm looking for stocks in a short-term uptrend that are going to run into their descending moving averages and be a great place for short if the market rolls. And Himax, the one-time Google Glass company, really looks good compared to everybody else. Broke out of a multiple-time top into to recent new highs, pays a 3% dividend. Kind of extended for my taste. Boy, I'm Mr. Bear today, aren't I? Application software. So cloud-based software did well this week, mostly because these guys came out with great numbers, Salesforce.com. But does this look like anything else we've seen? Yeah, it looks like Palo Alto Networks. Stocks in a downtrend that rally on good news, that run into their falling moving averages, become potential shorting candidates. So when would I short that? If the major markets start to roll over again and I get a momentum signal to the downside, I'm going to look to short stocks like CRM. Against short them then is I wouldn't expect it to fall much below the 17-day moving average. It's only about a 10% move. Autodesk, great earnings, huh? Same story. Market rolls over, it's at a nice shorting opportunity. You know, I'm trying to find great stocks for you to go along with, folks. Just not seeing them today. And entertainment content. So I typically, every night, will go through the top 10 groups. Short potential. We're running back up to descending 200-day moving average. Again, if the market rolls over, these are the kind of stocks I look to short. All right, so I haven't found a lot of stocks that jumped out at me. How else might I find stocks? I might go into all securities, and I'll run some of my favorite scans. Let's look at stocks that are pulling back to within 2% of free parking, which is the 50-day moving average. Let's see if I can find any of these that have an uptrend, and all these have momentum coming in as well. I like the first one, Boyd Gaming. So, is this stock over the longer term in an uptrend or a downtrend? It's kind of loose, but it's been in an uptrend from 6 up to 18. Okay? So long-term uptrend, it's been in a pullback down to the 200-day moving average. It closed above the 50. It had a Kahuna come in, a mobile breakout. I don't like the fact that the weekly bond goes negative, but the forces, both long and short, did turn positive, which I like to see. It's got great earnings coming in that are above its multiple, which I like to see. Its earnings are already out. Boyd Gaming would be one that I put on my list, which it already is on my list. I don't need to go put it there. All right, we found one. Hey, Eagle Bank Corp. If I wanted to buy a bank, I have to learn more about Eagle Bank Corp. Like, where is it? Is it a Bethesda, Maryland? Montgomery? Probably not a lot of fracking with this bank. Don't like the weekly bongo being red, but I'm buying it off of support with momentum. This is what I like. PSAI reversal and a Kahuna and a mobile breakout from a squeeze. That looks fine as well. And here's another bank, similar story. Don't know anything about this bank. All right, that's one of my favorite scans. How about stocks that are squeezing right below their PSAR dot? I'm looking for stocks that are basing, that are right below a point that they might want to, where they could be breaking out. So here's FSIC, bit of a downtrend, 2 Kahunas, I like that, coming out of a squeeze. I don't like it. It's got too much resistance above it with that 50-day moving average, so I would pass. Notice it pays a 10.8% moving average, which all these asset managers seem to be paying now as they got clobbered. Old National Bancorp, another bank. A lot of banks. Yep, nothing there. What's my appetite? I didn't even bother telling you what I didn't like if I didn't like them. I also look at my top bongo stocks. Here's one I like a lot. Applied Optoelectronics. So let's do an anatomy of this stock because this is one that's on my buy list. Let's drop it out to a weekly. Kind of all over the place. That might be enough for me to pass. It's also a young stock. It was an IPO back in 2013. Now I see a stock that's been going sideways to down. It broke above the 200-day moving average, the 8 and 17 above the 50. It's coming out of a mobile breakout from a squeeze. The bongos are all green. It's got two kahunas to the upside in a row. It's got some earnings coming into the stock. I like AAOI. It's already on my buy, which I don't need to add it. Diplomat Pharmacy. This one's a buyout. Energy Focus. I also like Adeptus. It's a healthcare stock. Great earnings per share growth. Earnings are not until April 28th. Two kahunas broke above the 50. If it just runs up to the 200-day and fails, that's another 20 points from here. Everything is green. Adeptus is on my buy list. So what I do is I go through the top 10 long industry groups and short, and I have a number of my favorite watch lists that I combine. And this week I ended up, I've changed my technique a little bit, but not much. I ended up with a consolidated buy list that had, let me put on the right, $624 stocks in it. I went through the top 624 and I came up with a buy list. Several of these you've seen already. And then I took my buy list and I ran it through my screens in Tradestation, and I'm left with my filtered buy list. So let's talk about these and then we'll say goodnight. The first three you've already seen, and these were three of my favorite stocks. Boyd Gaming, Adeptus Health, Applied Optoelectronics. Rackspace you saw, here's an MLP. Look at a couple more. A couple weeks ago I said you might want to consider TCK and FCX. That was 2 weeks ago to be exact. And I said that because they look like they're done going down, their fundamentals suck, but there's got to be an inherent value to the stock. This guy pays a 2.4% dividend, huge demand versus supply. And I said in those stocks, you know what, at some point you just buy something and you forget about it, you call it a lottery ticket. I'm feeling that way about U.S. Steel if it can take out that PSAR dot. So the ones I talked about, and we have to count back 9 days, there was a holiday, TCK. Talked about it, less than $5. It ran up to nearly $7. And I have a nice profit in TCK. And then the other one I looked at in a similar pattern as X would be FCX. And we looked at it down here. And again, it doesn't look like much, but a 6 to 8 move is a 25% move. I got in at less than 6 and it's not quite $8. So I like to look at some of these beaten up stocks. They're not growth stocks. I'm not buying them because of my signals. At some point I look at something and I say, you know, it's gotten so cheap, maybe I want to play it. Before I jump into Tradestation, a couple others that I liked were Immersion. This is a technology stock. Kahuna up to the 50. If it took out the high of its day, it might run up 20%, all the way up to its 200-day moving average. Earnings not to May 5th. And then two fertilizer stocks. CF, long downtrend, broke above its 50. Mobo breakout, everything turned green. And Mosaic is another one. We'll come back to that one later. Broke above the 50 with a Kahuna and a pocket pivot. Mobo breakout from a squeeze. Everything is green. It makes money. Trades at a multiple of 9 and has a dividend yield of 4.1. So I take that list here, my big list, I dump it into Tradestation, and this is how I trade during the day. So let's go into Screener. And this was that list of stocks. So let's just take a look at why I like them. Here's AAOI. So we got monthly, weekly, and daily. I have price. Make some of this, clean some of this up a little bit. Person histogram, OBV with a moving average. Then I have a series of my indicators and then regular volume. I have these arrows are the person indicators. The white is a 50-day simple. The red is a 200 simple. The orange means a high close doji. So this is AAOI. I should have bought it a week ago when it had a high close doji. It had a nice up move. It's still down from where it was a month ago. Look at how OBV is strong on both the weekly and the daily. PPS daily, PPS weekly. It's run a little bit. I still like AAOI. I mentioned Adeptus. It has a brand new weekly PPS buy. It's in a daily PPS buy. Strong OBV on the daily, will break above its moving average on the weekly. It too has already had a big run off the bottom. Why is that a problem? Because typically I like to find a good place to put my stop, and the lowest in the last 4 days makes sense. 1, 2, 3, which would be around 45 when the price is 59. I don't know where to put a stop in this. It's had such a dramatic move over the last week, so it's probably too far gone. AAOI, on the other hand, I would put my stop probably, it's had a big move too, 20% away. That's why I didn't pick it as my stock of the week. AEO, weekly buy, high close doji on the daily, strong OBVs. Builders First Sources has been in a downtrend. Notice how the histogram is less negative, even though the stock kept getting lower on the weekly. That's a bullish signal. PPS weekly buy, PPS daily buy, high close doji on the weekly, high close doji on the daily, OBV heading up on the daily, lagging a little bit on the weekly. I like Builder. It looks like it's been beaten up too much. Let's take a quick look at it. So the good things about this stock are I would put my stop 3, 4, probably about here, the low of that day. So let's open that up. So stop would be at 689. I'd buy it if it goes higher than this. So it's still at 795, so it's $1.06. Still about a 15% stop. Too much for me. I want to buy stocks that I can get away with less than a 8% for the most part, although I will go to 10% on a stop loss. All right, let's go back to Tradestation. Here's Boyd. HCD on daily and weekly, PPS weekly and PPS buy. OBV is strong. This one looks great. And there's a $2.10 between the last conditional change, which is a good stop point to put, and where I'd buy it at. I thought it was too far away. I like the chart if I can get a little bit of a pullback. CF, fairly long pullback, had a HCD a week ago, PPS weekly and daily buys. OBV is strong. That could have been a good pick. This is a MLP, DPM, weekly high close doji. It's in a weekly sell, daily buy. OBV is strong. I'm getting tired, so let me go to look at X, and then I'm going to look at Mosaic, and then I'm going to say goodnight. Here is X, and you could see right below the 200-day moving average on the weekly, broke above the 50 and the 200 on the daily. PPS weekly buy, daily buy. OBV is strong. High risk stock, but this is one that I might be nibbling at this week. And let's go take a look at Mosaic, because this is my stock of the week. So once again, these are for educational purposes only and not in a stock tip. I do not warrant these, that they're going up or going down. I may or may not have a position. I may or may not take the trade. And I'm doing this not to show off or show stock tips. I'm doing this so that I have something to talk about next week, and I'm able to apply much of what I teach and what I do. So I'm looking at Mosaic. So Mosaic is a fertilizer play that's been in a downtrend. Now, if I go back to the middle of January, it's been in a nice uptrend. So it's in a new uptrend. Notice that my bongos have gone green, as are my forces and my accumulation. I am getting to the top of the high jump bar, but I don't look at that in a stock that's been in a downtrend, so that I toss out. I have a squeeze and a mobile breakout on Friday. or a squeeze in over on Thursday, and then a squeeze still on Friday. I had a pocket pivot and a Kahuna. There's nothing there but good stuff. I looked at the Tradestation. I had a PPS buy on the weekly. I'm in a PPS buy on the daily. OBVs are leading. I looked at it and said I'd go long at 27.05. My stop I put down here at the last conditional change at 24.40, or right below the last conditional change. That means I'm risking $3. Wait a second. I'm risking $2.65 per share, just under 10%. Since I'm willing to risk $2,000 of my hard-earned money on any trade, that means 2,000 divided by $2.65. I can buy 750 shares as long as I obey my stop rules. I plotted here. I go long if I hit that white line. That's my first target, the green line, which is the 29.70, and here is my stop, which is the red line. So I will put a buy in tomorrow. If the market opens up flat or up, I will then take half off when I hit the green line. I will move my stop to half to the purchase price, and then I will let it ride and apply some more fancy trails or chandelier stops at that point. So what am I going to buy? Well, I might look at calls, stock, or a synthetic stock. I'm not going to go much into this, but these are multiple trades that are bullish on the same position. You notice on the left is a pattern where I buy the stock. If the price goes up, I make money and I'm green. If the price goes down, I lose money. Not that crazy, right? All right. How about if I buy a call and sell a put at the same price? I might get paid a small amount to take the trade. I might pay a few pennies to take the trade. Did you notice anything about the P&L curves? Yes. For a small investment or for a credit, I am getting the same risk and benefit if I bought the stock. This is risky because you can still lose money. This is risky, long stock, because you can still lose money. Or you can go and buy a call, which is an option that lets me buy the stock at a specific price. And as you can see, by buying a call, I can make money, but my loss is fixed at the price of the call that I purchased. In fact, if I go back here, if I want to control 100 shares on that's one call, it'll cost me $131 to control 100 shares. I can make an infinite amount. The stock will have to move about $1 for me to break even, but my profits are infinity, and all I can lose is $131 per 100 shares. Pretty darn good, huh? That's why people buy calls. But remember, if the stock drops, you're going to lose your premium. If it stays the same, you're going to lose your premium. And if it goes up 50% the day after your option expires, you might lose your premium. If I go long stock to buy 100 shares, I've got to invest $26.82. I can risk the entire $26.82, and I have an infinite gain, which isn't too bad. Or that synthetic stock where I buy a call to go long at $26.50, sell a put to go short at $26.50. I net out, it costs me $6.50 per share, per 100 shares rather. So I get in a lot cheaper than anything else. I could be like a millionaire and buy thousands of shares. Not that I would, because you have the same risk. My gain is infinite. My maximum risk is pretty much the same thing as going long the stock. So pick what you like. I kind of like the synthetic longs because I get in at very little out of pocket. I manage it just like I do the stock. Most I'm going to lose is probably about 8% where my stop is, and I stop myself out either way. The lowest risk is the long call, but it costs me a lot more money to get there. Just a quick reminder, I've got this great group called the Pug Users Group. It meets a couple times a month. John Person comes in at least once a month. Our mission is to make you better traders using HGSI and John Person's indicators. Pretty much everybody in the club owns HGSI. It's not required, but it's highly recommended. It is required that you have a lifetime subscription to John's stuff, which is, it's a couple $1,000s or more. Reach out to me if you have interest. I can let you know more about it and see if there's any kind of specials being offered. Love to have you join, and if you like the stuff we do on this call, then it's the kind of thing that we do when we get together. We'll see you next time. I have a meeting in Florida, and if I see you, and come say hi to me if you're in Orange County at the meeting I'm at this week. Have a great week. Futures have turned less positive, down a little bit. Again, remember, fair value is below baseline. So right now it looks like trading below fair value. Let's see. Yeah, something's not right. We're not all matching up the same way. I must have lost my signal. But according to a short delay, our NASDAQ futures are about 15 points below fair market value. E-minis are currently 6 below, and Dow futures are about 50. So I figure out what's happened to my feed over there. All right, everybody, have a great night, and thank you.